Today on Retiring Well with Michael Reese, we are talking about the IRS and surviving spouses. We'll discuss how the death of a spouse can drastically increase the income tax for the surviving spouse.
How does the IRS treat a surviving spouse? Why do they treat them that way? And what can you do about it if you don't like what you get?
And later in the show, Mike will share how you can plan ahead to significantly reduce your tax liabilities.
There's a couple $100,000 for your surviving spouse. They can use that money to pay the IRS off, convert it to a Roth. So give the IRS money, give it to an insurance company. Either one, much better deal than leaving it for your surviving spouse to deal with.
All this and more on Retiring Well with Michael Reese, starting right now.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and I am really excited about this week's show because we're talking about our favorite topic, taxes. Ugh, I know, I hate taxes too. But this is actually going to be fun because we're going to talk about taxes and specifically how does the IRS treat a surviving spouse? Why do they treat them that way? And what can you do about it if you don't like what you get? So that's going to be actually a pretty good show. But before we do that, as I do every week, I want to take a moment and share with you why we do this show. I believe your best is yet to come. I believe that the second half of your life is going to be filled with, it's going to be absolutely fantastic. You're going to be able to pursue activities that provide meaning in your life, that provide fulfillment. You're going to get to do everything that you've always wanted to do. Well, that is, of course, provided that you're making smart choices with your money. Because let's be honest, if you want to pursue activities that provide meaning and fulfillment, a lot of those activities, they cost money. You need your money to work hard for you. You need your money to support those types of activities. And if you want your money to do all that, you've got to make smart choices. And the problem is that most of our financial media, that's not what they talk about. That's just not what they talk about. They talk about how to build, how to grow, how to accumulate a portfolio. What they don't talk about, though, is, hey, once you've hit the point of financial security, how do you protect what you've worked so hard to save? How do you take income? How do you grow it while all of that's going on? It's a very different environment than just growing and accumulating where you're adding money into the system. It's a whole different world, and you need to make different choices. And that's where we come in, is our role, help you make those smart choices so that you can protect what you've worked so hard to build, so that you could take some income, whether currently or in the near future, and still grow your portfolio, doing it in a smart way. All right. Every week I ask you the question, have you called the number on the screen yet? Have you called us? Have you gotten your complete retirement review done? It's free. There's no obligation, so there's no reason not to do this. When you call our office for a complete retirement review, here's what you get. First, retirement income planning. Will your portfolio be able to generate sustainable income for the rest of your life? Are you going to make sure, are you going to run out of money or not? We help you identify that. Next, risk analysis. How much risk? How much are you taking with your portfolio? Third, investment costs. This is my pet peeve, by the way. You see, I believe in transparency. I have this crazy notion that when you work with someone, that they should be willing to tell you what they're charging you. You work with a lawyer, you work with an accountant, they tell you, hey, it costs this much. So why is it that the financial industry works so hard to hide what they're charging. I think it's ridiculous. It's, in fact, in my mind, a bit offensive. It should be transparent. We're going to tell you what your money managers are charging you, and then you can determine for yourself whether or not they're earning it. And then, of course, tax analysis. That's kind of today's topic, and that is, how do you keep your taxes to a minimum? What are you doing about your largest taxable asset, which is probably your IRA, 401k, or 403b? What are you doing about those types of accounts? Are you transitioning from them to something more tax advantaged regularly, consistently, systematically, or aren't you? Okay, it's pretty important. Call the number on the screen, come visit with us. We'll help you with all these areas. And again, it's free, no obligation. All right, let's talk about surviving spouses and the IRS. It's really, in a sense, almost heartbreaking. It's pretty sad in a way. And the way to share this with you is I'm going to give you one of our clients, real life story. We had a couple, very nice couple. All their bills were paid. They were living on $6,000 a month. That was their income. Every month they had $6,000 coming in. And they had no bills, so they were happy. That $6,000 covered everything. And when it came time to fill out their tax return, because we do the tax returns for a lot of our clients, we filled out their tax return for them, and guess how much they owed the IRS? There it is, right there on the screen, about $3,200, $3,300. And I got to ask you something. Is that horrible? Is that a terrible number? I don't think so. I mean, think about it. They've got $72,000 of income. They're basically paying what? 4 or 5% in effective taxes? I know this, if the IRS came to me and said, hey, Mike, tell you what, we'll make a deal with you. You pay 5% of everything you earn for the rest of your life and we'll call it even. I'm going to jump on that. I don't know about you, but I know I would. That's a pretty good number. So everything's going pretty well for them. But things happen. And you know, we're talking about surviving spouses, so we need to pretend that one of them died. And of course, we're going to pick on the husband here because it's not correct to pick on the ladies. And I like to joke and say, maybe he got involved in some crazy biking accident. And off he goes. But meanwhile, the wife still wants her $6,000 a month, $72,000. So she does her tax return, or we do it for her, and we get a different number than that $3,200. In fact, now that he's gone and she's on her own, the IRS charges her $10,000 a year on the same amount of income. 3 times more. That's $7,000 out of her pocket. Why? Why? And more importantly, why didn't anyone tell them that that was going to happen? Why? Well, I don't want you going anywhere because coming up after the break, I'm going to tell you why it happened and why no one talks about it. Don't go away.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Listen, are you an employee who is participating in a 401k plan? Are you aware that in some cases, you'll be able to roll out of the plan even though you're still working?
Are you tired of the choices you have and possibly the lack of professional help in getting you to your retirement goals? If you're looking for an alternative approach to help you protect your hard-earned retirement savings, then we may be able to help. You may be entitled to an in-service rollout of your 401k plan.
A rollover to a self-directed IRA may be an appropriate solution for you. Contact us at Centennial Wealth Advisory today. Take control of your retirement. Centennial Wealth Advisory can help. Please call the number on the screen.
Did you know that the best financial advisors in the country never put mutual funds in their clients' portfolios? In fact, they avoid mutual funds like the plague. Yet I'm betting that if you look at your portfolio, your retirement savings, you're probably sitting on a lot of mutual funds. There's a bit of a disconnect going on there. You need better information. To give you that information, we've delivered a free report on our website. It's called Mutual Funds, the Good, the Bad, and the Fine Print. Absolutely free to you, and here's how you get it. You go to our website, send-wealth.com. When you get there, over here on the left, it's right here, you'd simply put in your email address and click submit, and it'll be sent right to your inbox. Welcome back. This week we're talking about how the IRS treats surviving spouses and why they treat them that way, and more specifically what you can do about it if you don't like the outcome. In our last segment, we talked about a client of ours. They're living on $72,000 of income. They're only paying $3,200 in tax. But if one of them dies, and it doesn't matter which one dies, but of course we picked on the husband who had a tragic biking accident, you'll recall. But if one of them dies, the surviving spouse ends up paying $10,000 a year. So why? Why is it so different? Well, the answer is this. I'm going to have to go to the whiteboard to share with you why that is, and I'm going to prepare you. There's going to be a few numbers here, but I'll walk you right through them. They're not nearly as complicated as you think, okay? They're actually going to be simpler than you think, I promise. So let's go over to the whiteboard and let's see what's going on. Now, when I come over here, we've got two columns. We have what's called both, which is when both the husband and wife are alive, and then her, surviving spouse. It could be him. Maybe she dies first, but we're never going to pick on the ladies on this show. We're only going to pick on us husky men. So where we can take it, right? So anyway, let's focus on this one. Let's focus on this both column first, because this is what their tax return looks like. So it starts out like this. Their Social Security together is $36,000. But not all of it is taxed. And that's what this next line is. The question is, well, how much of that Social Security is taxable? And there is a complicated equation called modified adjusted gross income that's used. But when all is said and done, of the $36,000 that they receive, only $14,500 of it is taxable, so a little bit less than half. They also have IRA. That's where the rest of their income is coming from. So Social Security, $36,000, IRA, $36,000. That's where they're getting their $72,000. But what of this? AGI stands for adjusted gross income. How much of that is taxable? That's $72,000. Well, it's the portion from Social Security that's taxable, $14,500, plus $36,000, so that gets us our $50,000. So they're earning $72,000, that's what they've got coming in, but as far as the IRS is concerned, their adjusted gross income is $50,500. Now, from there, we get to subtract a couple things. We get to subtract the standard deduction and personal exemptions. That's what we get to deduct. The standard deduction for a couple, $14,800, the exemption $79,000. So when all is said and done, you take the $50,000 of adjusted gross, subtract out these two items, and taxable income is $27,800. That's what they actually have to pay tax on as a married couple. When you apply the tables that tell you, okay, for a married couple, here's what the tax tables look like. $3,266, that's the number that they end up paying tax. That's their tax liability on $28,000 of taxable income. So they started with $72,000, but when all is said and done, they only had to pay tax on $27,000 of it. And tax on $27,000 was only $3,200. Okay, pretty simple, right? I mean, maybe it's not so simple, but that's how it works. Now, one of them dies. And as we said, we're picking on the husband. The husband dies. The wife is left on her own. Let's see how taxes work for her. That's this column right here. Now, a couple things are going on here. Social Security is only $24,000. It was $36,000. What happened? Well, what happened was when one of them dies, she doesn't get to keep both Social Security checks. She only gets to keep the bigger one. In our example, we just, he had $24,000. She got half of his, $12,000. So she kept his because his was bigger, $24,000. But she still wants $72,000 of income. Where does she make up the difference? Right here, the IRA. She pulls out $12,000 more in the IRA. So instead of pulling out $36,000, she pulls out $48,000. But here's what's kind of interesting. Notice this. Social Security, $24,000. How much of that Social Security is taxable? It turns out 85% of it, almost all of it, is taxable. Because when they do that MAGI calculation, modified adjusted gross income calculation for a single person, she gets slapped. It's just a higher number for a single person. So now adjusted gross income is taxable plus the IRA. You add those two together, it's $68,400. So already there's trouble because it was $50,000 when it was both of them. Now it's $68,000. And then what does she get to deduct? Not as much because there's only one of her now instead of two. So she gets to deduct roughly half of what they got to deduct before. So her taxable income is $56,000. She's getting $72,000 of income. She pays tax at $56,000 of it, or almost double what's going on over here. But it's worse because this number, the single tax brackets are applied to that number. Married tax brackets were applied to this number. Single tax brackets, I don't know if any of you have looked at those lately. They're not pretty. And at the end of the day, she owes $10,000 of tax on that. That's why she ends up owing more. The big problem here, most of her income's coming from a taxable IRA. That's what's causing the trouble here. Now don't go anywhere because after the break, I'm going to tell you how to fix it.
You don't walk into a doctor's office for some blanket prescription for whatever ails you. You expect individualized attention, a doctor who listens, and a treatment prescribed to meet your specific need. When it comes to your financial future, why expect anything less? If you would like an independent checkup from an independent advisor with access to hundreds of possible solutions to help you meet your goals, contact us today.
Do you know that there is one mistake that we see retirees make, or those who are nearing retirement make? And we see them making that mistake over and over and over again. That mistake is simply this. They are taking too much risk with their portfolio. It's almost like it's the fourth quarter of a football game. They're up by 10, they've got the ball. All they got to do is make sure they don't fumble it away. Well, here's my question for you. What about you? Are you taking too much risk, or are you getting ready to fumble the ball? Well, how do you find out? It's really simple. You just go to our website, sun-wealth.com. In the upper right-hand corner is a link for your free portfolio stress test. Click the link, follow the instructions, and the results will come to you immediately.
You've always known how to enjoy life, to make every moment count, to explore and push the boundaries, to never stop growing. And with all this, you know your best is yet to come. Centennial Wealth Advisory. Portfolio stability, tax reduction strategies, lifetime income, financial security in any economy. Centennial Wealth Advisory. Your best is yet to come.
Welcome back. This week we are talking about the IRS and surviving spouses. We've given a real life example. Couple making $72,000 a year, they're paying $3,200 in tax. One of them dies, surviving spouse pays $10,000. In our last segment, I just showed you why. And it probably gave you more numbers than you want to hear, but it's basically because it's a single taxpayer versus a married. That's what it really comes down to. And the big question you should be asking yourself is, well, why didn't anybody tell them? Why didn't the accountant tell them? Why didn't the financial advisor tell them? Because guess what? The accountant, they've had people die. The financial advisor, they've had people die. They know this happens. Why didn't they tell them? Well, if you're the financial advisor, it's real simple. They don't make any money on taxes, so what do they care? And the accountant, I mean, you've dealt with accountants. They don't focus on the future, do they? They focus on the past. What happened last year? Let's get the right numbers in the right boxes. Got that done, our job is done, we don't go any further. I mean, it's not unless you're talking to true retirement experts, retirement planning experts like we are, that this even comes up. All right, the question now is, okay, well, we got this problem. The problem here is what? This guy, who is doing the best he can, he left her a big old IRA in this example. He left her a big IRA. All of her income's coming from IRA, which means it's all taxable income. This is a key point. This is huge. You've got to understand this. Ask any accountant this question, they'll tell you what I'm about to tell you. Ask them, what's better to leave a surviving spouse? A regular IRA, a Roth IRA, or life insurance? If I had to get rid of one of those, what's the first one I'm getting rid of? Every accountant's going to say the same thing, the IRA. Why? Because it's taxable. The other two are tax-free. Simple. The problem is he left her a big old taxable account. That's where she's getting her income from, so the IRS is going to pummel her every single year. And oh, by the way, if she dies first, it's the same deal for him. It's no different for him. So how do we fix it? Well, we need to bring up our man, Mr. Fix-It here. And there are two ways to fix the problem. Here is number one. You can do Roth conversions. Now, I'm just going to use, let's forget about this client and just talk about you for a minute. Let's say you have $500,000 in an IRA, and you're thinking, that's what I'm going to leave to my surviving spouse for their financial security. Yet we just saw that the IRS starts drooling when you do that, because the IRS knows, that's awesome, we are going to collect big time. Okay, we don't want the IRS to collect big time. We want to protect your surviving spouse. So one thing you could do is you could start doing some Roth conversions. You don't have to convert the whole thing all at once. You can do it in steps and in stages. But if you had a $500,000 IRA, over time you could convert that to a Roth, or a big chunk of it if you wanted to. Now, if you did that though, you do have to pay the IRS dollar for dollar. You got to pay them the tax to do that. But hey, wouldn't you rather pay that tax when you're married and the tax rates are lower versus having your surviving spouse pay for it later when tax rates are higher as a single person? I mean, pay it when it's lower. But still, $500,000, it's probably going to cost you $150 to $200,000 in tax when all is said and done. It'll cost your surviving spouse more. Or, what's number two? You could buy some life insurance. Think about it this way. You could give the IRS $150,000 to $200,000, or what you could do is buy a couple $100,000 of life insurance, pay premiums of maybe $5,000 a year, live for 20 years. That's $100,000 of premiums, $100,000 out of your pocket, but you die. There's a couple $100,000 for your surviving spouse. They can use that money to pay the IRS off, convert it to a Roth. So give the IRS money, give it to an insurance company. Either one, much better deal than leaving it for your surviving spouse to deal with. That's how you fix it.
Do you have a plan for how to generate income during retirement? Are you going to run out of money? In today's marketplace, retirees have concerns about the volatility of the market. People have concerns that the traditional balanced portfolio strategy that advisors used in the 80s and 90s isn't good enough in today's new normal economy. There are more secure options available for you today, and that's what we specialize in here at Centennial Wealth Advisory. If you don't yet have a plan or would like a second opinion on your retirement income plan, please call us today for a free, no obligation, complete retirement review.
You've worked hard for your money and your best is yet to come. You've reached a point where you don't put your money at risk anymore. The road ahead doesn't scare you because your money is secure and working for you. Centennial Wealth Advisory, portfolio stability, tax reduction strategies, lifetime income, financial security in any economy. Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Let's go ahead and recap what we learned today. First, surviving spouses can get hit hard by the IRS. Basically, what are we dealing with here? When you're married, you're in the best tax brackets there are. One of you die, surviving spouse, go from best tax brackets to worst tax brackets, single tax brackets. And it can be significant for a lot of people. Second, inherited IRAs or 401ks or 403bs, these inherited retirement plans, they can cause chaos on this tax return. The IRS starts drooling when they see an inherited IRA hit a surviving spouse because it's great news for them, not good news for you. How do you fix it? Well, while you're alive, do some Roth conversions. Maybe look at buy it to life insurance. Either one is good. Pick something. Don't just sit there and take it. Now, as we wrap up today, I want to again talk about this complete retirement review. It's free, it's no obligation. Call the number on the screen. Come visit with us. Let us help make sure that you are on track for a successful retirement. We will do things like look at your retirement income planning, run a risk analysis, see where you are with risk. What are you paying your money managers? We put that out there. And of course, we look at taxes. I mean, that's what we talked about today. Hey, what does your tax return look like? If you're married, when you die, what does a surviving spouse tax return look like for you? We'll tell you. We'll show you. Plus, we'll give you some ideas on what you can do with your IRAs and 401ks, etc. So make sure you call the number on the screen. Come visit with us. It's free, no obligation. You'll be glad you did. And that, my friends, is our show this week. Have a great weekend.